Hey, it's Realtor Jess here to talk about the 4 pillars of pre-approval. The question I get asked the most is, how do I prepare to buy a home? Okay, look, Jess, I know I want to buy a home in the future, down yonder, but I want to start preparing now. What should I think about? I got you. I'm going to break down the 4 pillars of pre-approval that you need to be thinking about now. And those pillars are IDCC: income, debt payments, credit score, and cash. Let's take those one by one. The first pillar, income, is all about determining how much money you have available to spend on a home each month, right? So seems pretty simple, and it is. Again, what I'm going to share varies by mortgage product and loan and even lender in some cases. So I'll do my next video on different loan programs. But kicking it off with income, pretty straightforward, especially if you have a W-2, employee, you're an employee job. The lender will look at your W-2 and they'll look at your pay stubs and basically divide that salary by 12 to get to your monthly salary. Or if you get paid weekly, multiply it by 4 to get to your monthly salary. But what if you have a special circumstance? What if you, let's say, just graduated from like law school and you want to buy a home before you get started in your cushy job? Well, the lender would ask for an employment letter showing your salary and your start date. And as long as that start date is within 60 days of you closing on the home, the lender would be able to use that letter as documentation. But what if you, let's say, already have a job, but you got a side hustle? And that side hustle brings in a lot of money, so you want it factored in. Or you're not an employee, you're, say, an independent contractor, and you're self-employed, like me. As a realtor, I'm self-employed. Well, self-employed people, lenders generally want to see 2 years of tax returns showing that self-employment income. So this is 2019. That means they would want to see your 2017 and 2018 tax returns to get a sense of how much you actually made in that business. So here's an important PSA. All of you business owners who love to deduct every single thing, that actually counts against you. So the lender is going to look at your profit from your business. So if you made, let's say, $50,000 in the last 2 years on your business, and you wrote off in deductions, deduct A, deduct B, deduct everything, and you wrote off, let's say, $40,000 of deductions, hiding that from Uncle Sam, the lender is going to see, oh, she only made $10,000 of income from that business. And you're like, but no, I brought in 50. And the lender's like, but you wrote off 40, so that leaves 10,000 for it to be counted. That's an important note there. The last note is about rental income. So one of my favorite strategies is to buy a home, live in it for a few years, and then rent that home out and buy another one. Pretty easy way to accumulate multiple properties. Well, when I go to buy my next home, the lender is going to factor in 75% of my rental income from the first home. Be careful here because they'll be factoring in 100% of the monthly expenses on that first home, but only 75% of the rental income. So it can make it a little bit tricky if you have a certain price point in mind for your next home. You might have to bring that down just a little bit for that 25% difference. But it is a great strategy if you want to hold on to that rental property long term. So those are the things to note about income. We got W-2, self-employment, and rental income. D is for debt payments. So that's the monthly amount you're paying for the debts that appear on your credit report. That's your student loans, your car payment, your credit cards, and it's the payment amount, not the balance itself, that matters. So for example, if you have $100,000 of student loans, let's say, and that payment would traditionally be maybe $1,300 a month on a standard plan. But thanks to an income-based repayment plan, you only pay about $300 a month. It's that $300 that lenders would generally include on your debt-to-income ratio, and irrespective of your $100,000 balance. So remember, it's the debt payments that appear on your credit report. C is for credit score. Your credit score tells the lender how trustworthy of a borrower you are. The higher your credit score, the better interest rate you receive on your mortgage. And that means the less interest that you pay over the term of the mortgage. So you don't need an 850 to get a mortgage. VA and FHA loans are available with credit scores as low as 580, and conventional mortgages can be obtained with a credit score of 620. The other thing to note is that these are not absolute values here. Credit score is going to be evaluated in tranches. So if you're from a 620 to a 639, you're going to get one score. And if you're, let's say, a 660 to a 679, you're going to get a better score. And if you're, let's say, 700 to 759, you'll get an even better score. And 760 to 850, you're going to get the best score. So if you're right on the edge, you probably want to work with your lender to see how you can kind of get pushed over into the better range. But it can always be worthwhile to just have an evaluation. So a lot of people say, oh no, I'm not ready. I want to do some more stuff before I let the lender pull my credit. And I'm like, I understand wanting to be prepared, but it's all about taking the actions that are going to get you the best result, right? And so the best way to know what a lender is going to be looking for is to have the lender actually look at it and tell you what needs to be done. And this has saved my clients so much time and money, because I have one client who thought they were going to have to spend years and thousands of dollars to pay off all of their credit cards before they could get a mortgage. And I encouraged, they got the pre-approval, and the lender said, hey, you just need to pay down a few $100s on your credit cards and you're good to go. And that saved them years and thousands of dollars. And they were able to get a home that they love. So it's always worthwhile to have a lender do a pre-approval, put your credit score as part of that, because the score that you're seeing on Experian, Credit Karma, these sites aren't what lenders are looking at. So you always want to get it straight from the lender that's going to be giving you the money. If you were borrowing money from, a friend, you wouldn't go ask a different friend how you can get that first friend's money. No, you go right to that friend and say, hey, what do I need to do? How can we make this happen? Always check with your lender about your credit score. The last C is for cash. You will need some cash to purchase your home, but not as much as you think. You'll need 3% for your down payment if you're a first-time home buyer, and you'll need 5% for your down payment if you're a repeat buyer, or if your mortgage amount is higher than the conforming loan limit, which is about $484,000. So if you're borrowing more than that, you're going to be looking at about 5% down. And then for closing costs, we usually estimate about 3% of the purchase price you'll have to pay in closing costs. And this varies by jurisdiction, by home, by deal. But usually I tell clients to estimate 6% if they're a first-time home buyer, 5% if they're a repeat buyer or a large buyer. So 6% to 8% of the purchase price is what we're talking here. The great thing to note is that this amount can be paid in a variety of ways. So obviously this can come from your savings. You're going to work, you're putting your money away. But it could also come from your retirement plan. Doing a loan from your retirement plan does not show up generally on your credit report, so that can be a great way to access a stash of cash that you already have. You're able to receive generally unlimited gifts from family, so mom and dad want to be a part of your first purchase, they're able to pitch in. And most importantly, I would say most states have a down payment assistance program. So in DC, the program will pay your 3% down payment, and it's basically each year it's forgiven as long as you live in the home. So lots of ways to come up with your cash. And another great way is getting the seller to cover your closing costs. This is probably like my favorite way. Sellers are generally able to contribute up to 3% to a deal. And so that's something that a sharp realtor can help you negotiate. But it's another great way to save on cash. And cash is last because it should never stop you from achieving your dream. Steve Jobs and Steve Wozniak started Apple Computer with $1,500, and it's now a $1 trillion company. So remember that trees grow from small seedlings. So never discount the amount of money you have because you can achieve your dream of homeownership. Time to recap. The 4 pillars of pre-approval are I, D, C, C. And now you know that means income, debt payments, credit score, and cash. I'll be diving deeper into these in subsequent videos, so be sure to subscribe so you can be the first to learn. Thank you so much for watching to the end. You are truly helping this queen achieve her dreams.